Welcome to Episode 4. Procure-to-Pay, how one purchase becomes 5 documents, 5 FI postings, and 1 paid invoice. 4 ideas. The loop of 5 documents, the to FI handoff, the 3-way match, and the GRIR bridge. Get these, and every procurement conversation in SAP makes sense. The Procure-to-Pay loop. 5 documents, 1 business process. Every external purchase in SAP flows through these 5 steps. A purchase requisition is raised by whoever needs something. A purchase order is the formal commitment sent to the supplier. A goods receipt confirms what arrived. An invoice receipt records what the vendor is billing. And finally, a payment run moves the money. handles the physical side. FI records the financial side. Each event touches both. Step 1. Requisition and order. A requisition is the internal ask. Someone on the production line needs 100 steel sheets. A buyer reviews, gets a price from the supplier, and converts the requisition into a purchase order. Once the PO is approved, SAP marks it as committed. An email or an EDI message goes to the supplier. And here's the interesting part. Nothing has hit the general ledger yet. APO is a promise, not a posting. The only thing FI knows so far is a statistical commitment, visible in CO for budget tracking. Step 2. Goods receipt. The moment the warehouse clerk posts a goods receipt, 2 things happen at the same time. Updates stock levels for the material. The inventory count goes up by 100 sheets. And FI auto-posts a journal entry. Debit raw materials inventory, credit the GRIR clearing account. No accountant had to type anything. SAP fires the journal from the movement type. That GRIR credit is a placeholder. We owe someone, but we don't have the invoice yet. Step 3. The invoice. The vendor sends an invoice. Before SAP posts a single euro to accounts payable, it runs a 3-way match. The purchase order. Quantity and unit price. The committed spend. The goods receipt. What actually arrived at the dock. The invoice itself. What the vendor is asking to be paid. All 3 have to agree within tolerance. If they do, SAP posts the invoice. Debit GRIR, that placeholder we created at goods receipt. Debit input, VAT. Credit vendor accounts payable. If anything disagrees, the invoice is blocked. Nothing hits AP until it is resolved. A quick note on the GRIR bridge. Goods arrive on one date. The invoice arrives on a different date, sometimes earlier, sometimes later. Both events should post immediately. Inventory shouldn't sit uncounted, and vendor liability shouldn't be delayed. GRIR is the clearing account that holds the liability between those 2 events. Goods receipt credits GRIR. Invoice debits GRIR. When both have happened for the same line, the account nets to zero. A healthy GRIR balance at month end is small. A growing one is a red flag that someone is missing invoices. Step 4. The payment run. F110, the automatic payment program, is the heartbeat of accounts payable. It picks every invoice that is due, groups them by supplier and bank, and produces a single payment file for each. Per vendor, it posts one journal. Debit vendor, AP, the liability we recorded earlier. Credit bank clearing. The output is a SEPA or ACH file. The bank processes a remittance advice to the vendor, and a cleared open item in accounts payable. Run F110 every week, and the vendor ledger stays clean. So if you stack all 3 FI postings from the same purchase, you see the rhythm. Goods receipt. Inventory up, GRIR credited. Invoice, GRIR debited. Vendor AP credited. The bridge flips. Payment, vendor AP debited. Bank clearing credited. Over the 3 documents, GRIR went from 0 to minus 12.5 to plus 12.5 and back to 0. The bridge has done its job. The purchase is complete, on the books, and off the supplier's clock. Quick recap of Procure-to-Pay. 5 steps: requisition, order, goods receipt, invoice, payment. APO is a promise. It commits the company but doesn't touch the general ledger yet. The goods receipt posts stock and GRIR automatically, straight from a movement type. The 3-way match between PO, goods receipt, and invoice is the sanity check before AP is ever created. And GRIR is the bridge that lets stock postings and vendor liability happen on different days. Thanks for watching the 4th SAP Concepts episode. Next up, order to cash, the mirror image. From sales order through delivery, billing, and cash receipt. SD talks to FI the same way just did. Subscribe so you don't miss it.